Welcome back, everyone. Hope everybody had a great week since I last was with you. All right, let's go ahead and get started. Gabe Velazquez here with transparenttrading.solutions.com. Hope everybody had a great week, and let's go ahead and get started. So, last Tuesday I was with you, and the markets were a little bit strong. We went over some levels, particularly that 3950 area in the S&P. We did cross that, so we had we had some strength in stocks, and essentially rallied all the way up to the 4,000 level. In fact, we at TTS are coming in short with we shorted the S&P. Let's see, 4015. So we're coming in short, and so that trade is working out okay for us. By the way, type in the chat if you're able to see me and hear me okay. Okay, I know we have a few people in here. So, okay, all right. So where do we go from here? Next week is going to be a massive week. Let's start there, obviously. We have earnings from five of the biggest companies in the S&P and the Nasdaq. The FANG stocks, all of the FANGs really for the most part are going to be reporting. So we have Google and Microsoft on Tuesday. We have Wednesday we have Facebook, and Thursday we have Apple and Amazon. And obviously the reaction to those stocks will be important, as they are a huge market cap weighted stocks in both the S&P and the Nasdaq. So we will have that; those will impact the averages. Okay, so keep that in mind. So remind you guys on Tuesday, right as I am coming on the line here on Tuesday, which I'm going to start doing every Tuesday and Friday. We will have Google and Microsoft, and then Facebook on Wednesday. Also, most important, Fed, right? The Fed announcement on Wednesday. So that's coming midday at 2:00 Eastern. So we have a huge week coming up. So we should be ready to break out. We have a lot of markets still kind of in ranges. We have bonds had a huge rally, particularly the 10-year had a big rally, and didn't quite break out. So we'll start looking for a breakout in the bond market, and in particular the 10-year. I've been talking about these and writing about these levels. The 10-year 120 on the 10-year is going to be very critical, as it would break the 280 yield mark. So it's going to be interesting. But I don't know if you guys were watching the bond market this week. This huge bond rally really came as a surprise to a lot of folks, and wondering why the bonds are rallying if the Fed is still tight, obviously on a tightening spree, and inflation supposedly is still rampant. Well, maybe the bond market is sniffing out additional weakness. I know everybody's talking about recession in the economy, and usually what you'll have is yields will usually come down on the long end of the yield curve when economic slowdown is starting to surface. So that could explain the big bond rally we had this week. Now, all in all, we still have not broken out of the ranges in the bond market, right? Exactly, Dennis. Yep. How you doing? Bottom line is this, everybody. If you look at I just mentioned the 10-year, and that really is the main one, even though I'm trading I'll get into the TLT. So if you look at your charts here, again, everybody pull up your charts, and some of you guys will be coming in way later. as the video comes out, whatever. So one of the things that I've been doing is uh, having you guys look at your charts so that when I go through these levels, I think it's actually more instructive that you yourself look at the charts rather than me showing you. So if you look at a 4-hour chart of the yeah, yeah, they did. In fact, I don't know. I don't know if you came in, but we are short from 4015. We shorted the S&P, so you can see that actually pretty clean on a chart. So in any event, look, if you look at the 117 and a half to 120 on a 4 or an 8-hour chart on the 10-year, you can clearly see we bumped against the 117 and a half level multiple times. We've had this big rally, but we still have to clear 120.19 on the 10-year. That's really going to be the important level. Similarly, on the 30-year, which actually I think I mentioned on Tuesday that we were still long volatility in the TLT, which we still are. In fact, we rolled that out for the next 2 weeks, and we're long 115 TLT calls, which are working out pretty nicely for us. The TLT has big resistance at 120. So if you are more of a ETF trader or an options trader, the TLT is a great way to trade the long end of the bond market. So we are still in that. In fact, again, we are long 115 TLT calls going out a few weeks. Okay, all right. So that's that. So to wrap up the bond, which obviously is very important. Clearly, bonds are sniffing out some weakness in the economy. One other point I want to make before I move on is other than, actually yesterday when the bond market really took off, we kind of had that usual dynamic where stocks were rallying and bonds were selling off to some degree, and that is typically what tends to happen, right? People buy bonds as a safe haven, they sell their stocks, and vice versa. When stocks are doing great, usually bonds would sell off. That is kind of back, it's kind of disjointed right now. We have a dislocation in the bond market, obviously, where earlier in the year we had bonds and stocks all going down and yields were coming up because of the tightening of the Fed and so forth. They pivot. But it's really interesting, the dynamic right now between bonds and stocks still, and it's going to be even more interesting next week. It's 75 points raise in the Fed funds rate is going to be in the bag, and I'll be with you guys on Tuesday before that. So that's pretty much baked in. It's always like what they say, and everybody, they don't have the next meeting until September. We've got 2 inflation numbers between now and then, and so on and so forth. So it's going to be really fascinating. But on a chart pattern, just take a look at that. 119, 120 on the TLT, 119 on the 10-year. Looks like we are in the cusp of possibly breaking out in the bond market. I'm looking for a breakout in the TLT and the 30-year coming up next week. So we'll see how that works. Okay. I don't know about that, Dennis, but in any event, by the way, if that is the case, if that is their last hike, I can't tell you what a monster of a rally the stock market would have. But they're not going to telegraph that. Yep, I know, but that it seems unlikely actually. So, anyways, but if it did happen, boy, you would have the Dow up 3,000 points in a day. I can tell you that right now. But again, let's see what happens. Okay, all right. So that's the bond market. On the averages. On the averages, very similar. We have these massive rallies, and the debate obviously now rages on, and it's probably going to get even more intense um, this weekend as to whether this latest rally, and it's been a pretty nice rally, was again just another kind of garden variety bear market rally, which is going to fail, and then we're going to go right back down to the lows, or it's the beginning of something different. I'm starting to see some changes, as I mentioned, even today. If you think about it, you would have expected a much uh, steeper pullback. Uh, and even at the end of the day, you can see we did actually start to recover. So it's very interesting right now. I think the market's still somewhat resilient, and part of the uh, rationale why the market sold off is because of the Snap earnings yesterday. It kind of rippled, kind of had a ripple effect on a lot of the media stocks, as you know, Facebook and so forth. So that was that. But again, interesting. Next week we've got Facebook, we've got Google, and all this. So it's going to be the market reaction is really more important than the actual, earnings themselves, and it's the guidance I think everybody's looking for. And so far, everybody, a lot of analysts and whatever were kind of under the assumption or making the assumption that because the economy's slowing and so forth, that the guidance was going to be terrible, which, in the case of Snap, it is. Uh, but and that stock just got annihilated, right? It sounded like something like 30%, actually from 15 down to like 10 or something. Um, but interestingly, the averages are still kind of holding on. So we shall see. We shall see. On levels, the next we're coming up to some. I just mentioned, if you look at your chart, you can clearly see the 415, 40, 15, 40, 30 on a 8 hour. It's a drop based drop. We did take that. But if you go up higher the curve here, and this is interesting because there's a huge kind of weekly distribution area in the S&P around the 4100 to 4200. If you look at it on a big chart, daily, weekly, you can actually see that. We're still a couple hundred points away from that. So it's going to be interesting next week to see if we can get up there. NASDAQ actually is right up against a weekly distribution, which could explain why we did sell off a little bit on the NASDAQ. But, again, nothing that you would say, typically what's been happening over the last couple of months is when we get to these um, high level, high time frame distribution levels, the market sells off pretty dramatically, right? Pretty sharply. So I don't know if you can glean anything from the fact that we didn't sell off that sharply today, even as the Nasdaq which is obviously the more important index right now. Part of it may be still that rates are coming down, so that could in fact be helpful to technology stocks, and the dollar's also coming off too, which is remember that these technology stocks, these technology companies derive 30-40% of their revenues from foreign exchange, and so that is kind of hurting, but a lot of them have already guided on that, so it's going to be interesting. Okay, all right, so where do we go from here? I think the Nasdaq has to get above the 13,300, the 255 to 13. I'm calling it 13,000 on the Nasdaq. Okay, to really clear the way, and we actually are bouncing off of a nice level as we speak here. If you take a look at your Nasdaq chart, you can actually see the level at roughly, what is it, 12,300, right? So we're actually catching a little bit of a bounce here on the close. If we break down through that, there really isn't anything way down there. I mean, on the breakout, the breakout occurred right around the 12,200. So that could actually act as a, the old resistance acting as support. So those are the levels I'm looking at right now. But all in all, rally still seems to me intact until we start breaking below 12,200. So I would still look to buy pullbacks up to that 13,000 level, and but obviously everything can change as we come in Tuesday, Wednesday, and Thursday of next week. Uh, that could change the whole ball of wax, right? Also of interest, one last thing, and then we're going to move on to other markets. The Russell. So the Russell initially looked like, we're talking about that 18K level. We did break above that, rallied very close to a very similar level, 1850 to 1860. You can see that on a 4-hour chart. Didn't quite get up there and then sold off. And now we're right back to the breakout point around 18K. So I'm going to be watching that very carefully. That 18K, if it can hold up here, and then we can get another rally off of that, that could, in fact, again, give us some indication that these small caps are trying to hold on. Now, remember, small caps are very economically sensitive, because and they don't have the FX risk, the foreign exchange risk, because most of those small cap companies are, U.S. based, and they do all their business here. So 18K is really the level to look at in the Russell, which you guys should be looking at, because the Russell could be the leadership now, okay? Because the Russell is almost like your economic barometer, if you will. If that continues strong, that it could indicate that the economy is not as weak as everybody expects. So that's kind of what I'm looking at for on the small caps. Okay. All right. Any questions, by the way? I know I have a. Okay. All right. Let's move on. We had ECB on Thursday, as you guys know, if you guys have been watching the news or whatever. So ECB did come out with a rate increase, 50 basis points. We initially had a knee jerk. The euro rallied. It's still kind of holding at par. Now it's, basically we are swinging back and forth. If you pull up the dollar index chart, you will see 106.50, 107.50 is the range so far. We do have a huge accumulation level at 106. So for the time being, I would say that the dollar is still on a pullback. I would deem this a pullback, still in an upward move, but it is starting to flag. So, and again, this is very important. If the dollar does break down, that would actually be a net positive for stocks as well, because again, that would also indicate maybe a lessening of inflation and so forth. So keep that in mind. In terms of any of the currencies, really, currencies are just kind of reflecting what the dollar is doing. So you're getting a bunch of back and forth. There are some interesting levels coming up, particularly in the Canadian dollar, which is a doll, right? Yep. So Canadian dollar is something I'm looking at. Also, I've been talking about the Mexican peso is a doll. So look at the dolls also. And what are the dolls? Those are the commodity-based currencies like Canada, New Zealand, Australia, and I would even throw the Mexican peso in there. So those are the ones I would be focused on at the moment. All the rest of the currencies are kind of just chopping around, really nothing. Yen still kind of, dead at the lows, and so is the euro. But, if the dollar does break down, the euro could offer some opportunities as a bottoming process. If it does happen, we're still kind of early on that. Still hasn't happened yet. Okay. All right. So moving on to the energy markets, nothing really going on in oil. Oil, as I mentioned the other day, I would just still deem it a range, and the range is very simple. You can see it on the charts. I talked about this on Tuesday. Top of the range is 100, and you can see that clearly every time. In this week in particular, we rallied up to 100 a barrel, and they, sellers came in. We're sitting at 95, very choppy, not a lot to do there until we either break down through 90, which next level is going to be down in the low 80s, or we break above 100. So if you're going to trade oil, just keep those parameters in mind and be very nimble, as trading in between those levels is going to be kind of tricky. Okay. Nat gas. Again, we talked about nat gas. It is kind of inching higher. It broke above. I was talking about the $7 level the other day. We did break above that, and now looks like we have, again, if you pull up a big picture chart of nat gas, you should be able to see a very big daily distribution area between 860 and $9 millionth BTU. And obviously the recent high here was 9.5. So that should stall things out. There is that, we have a heat wave going on here in the States, as you know. There's also lots of stuff going on in Europe regarding, Russia energy. They just opened up the pipeline in Germany, but still they've got a heat wave as well there, and they've got some major energy crisis going on aside from everything else going on in Europe. So still the fundamental backdrop for nat gas still looks positive. So it's going to be interesting what happens around the $9 area. And if temperatures do decide to cool off, which some of you guys in the East are just sweltering, right? With a ton of humidity. Yeah, that's going to be interesting to see. So on a technical basis, I would still buy pullbacks in nat gas down to about the, I would say down to about the $7.5 level. But once we get up into the $8.60 to $9, I would be a lot more cautious to go long in that gas. Okay. In the grain markets, again, grain markets under pressure still. I did mention, now one of the things noteworthy, if you are trading grains, I did mention the 740 level in wheat. We are getting there. However, here's the deal on wheat. If you're trying to trade that on a futures basis, the levels are extremely wide. You probably cannot get away with any kind of level in wheat unless you're willing to risk, anywhere between $500 and $1,000. And so an alternative, if you are looking for a long-term recovery in the grain markets, you may look at an ETF called W. So there's actually 3 ETFs that cover the grains. There's WEAT. Check it out. It's like a little $8 number. Corn, CORN. And then there's SOYB to cover the beans. So you guys have that option, if you will, if you are not able or willing to take the risk on with the futures contracts when we hit these lows, to take on a longer term position by shares of, again, WEAT, CORN, or SOYB. Okay. So the levels, again, just a reminder, the one that's getting the closest is wheat, right around the 740, let's call it. You can see it on a big chart. And use the contract specific on the grains, because again, there's a lot of distortion on the charts because we went from the old crop back in July to the new crop, which is November in soybeans and December in corn and wheat. So make sure you're using contract specifics. You can actually see those levels. Again, reminder, soybeans at 12.5 a bushel, corn at 5.55 a bushel, and wheat at 7.42 a bushel, right in there. So it looks like wheat is getting really close. So we'll be taking a look at that next week, over the weekend, and so forth. All right. Okay. Any last? Yeah. Again, so just to kind of finish off, again, very strong rally. Hopefully, you guys were able to. Again, there weren't a ton of levels to really capture on the upside unless you were in from a couple of weeks ago. So it's been a 2 week rally, or again, unless you were in options or something like that. But now we are coming into some critical levels with all the data coming out next week, with huge again, these big cap stocks coming up, and the Fed. So it's going to be a real exciting week, and I'm looking forward to it. Hopefully you guys can take advantage of some of that situation. Again, it's been a very challenging market intraday, because even today, after the big, yesterday we had a big rally, and then the thing just faded intraday. Today we had a drop and just couldn't get any traction to the downside. So it is a little bit frustrating. Last thing, I actually was asked about this a little bit ago. Kind of a head scratcher at bear market rallies, or what happens in bear markets. Again, I'm going to leave you with this: the biggest, most ferocious rallies in stock market history have happened during bear markets, right? So go back to 2008, go back to 2000, go back into the 90s. And that is a function of volatility. So people that are not familiar with the stock market always scratch their heads and go, if we're in a bear market, why am I losing money when I short the breaks? And so just keep that in mind. I always tell people, if you're going to short in a bear market, short the rallies into distribution levels after the market's jumped. But then you're also, again, then you're missing out on some huge buying opportunities, because maybe you're too stuck on the fact that we're in a downtrend, or we're kind of in a bear market, and so forth. So you got to open up your mind and understand how the markets actually work. Okay. All right, everybody. Thanks for joining me. Have a great weekend, and I will see you guys on Tuesday. So regularly now, I'm going to be doing Tuesdays and Fridays, if you guys want to follow along. Also, do me a favor, subscribe to the channel, put some comments in there. I'll be glad to answer, and check out the website, transparenttrading-solutions.com, if you want some more information on what we do, how we do it. If not, have a great weekend, and I'll talk to you on Tuesday. Take care, everybody.